Good morning. I wasn't expecting that freaking voice crack. Good morning, everybody. Welcome to Trey's Trades. How are we doing? It is your boy Trey. I think that's what they freaking call me. We're going to give you a short video this morning as I've been asked by lots of new apes out there about call options. We're going to make this as short, simple, sweet, and to the point as we possibly can so that you can utilize call options if that is something that you are interested in doing. I have a video that I've used before. It's a little bit longer. It's about 25 minutes. So I'm going to try and keep this nice and sweet and explain this to you in a very simple ape language way. So let's just get right into this video so I can save as much time as possible. So there's a couple of things that you want to know about call options before you start rocking them. And it's these specific terms: gamma, delta, and theta. These are the Greeks, which explain to you essentially how call options get their intrinsic value. And then in the money, out the money, and then the potential risk of each of these, which you can associate with premium, right? That was a weird looking P. But nonetheless, we're going to go over each of these terms. So first I want to start off with the gamma, the delta, and the theta. So if we come over here to the options chain on AMC, right? Call options are a great way to leverage cash. And in order to understand how much money you're making with your call option, you want to understand these Greeks. So delta is the first thing that we're going to start with, right? So this is how much you make per share because a call option has 100 shares per contract, right? 100 shares a contract, you would make 64.5 cents with every point change on your call option. That is what the delta is. It tells you how much intrinsic value you are gaining per share for each contract, right? So if you were to gain 64.5 cents, right, on each point change, that would mean that you're gaining $64.50 with every point change on your call options, right? Because if there's 100 shares per contract, that means that you multiply this number by 100, which gives you $64.50, right? This tells you how much you're making. Now, on top of that, you've got the gamma. The gamma tells you what that point change is, right? So if you, for example here, you've got 1 cent is the point change on the gamma here, meaning that every time this goes up 1 penny, you are making $64.50, plus if you multiply this 0.01 times 100, that would give you $1.10. So with each individual point move, which is this gamma right here, right, you're making just under 66 bucks for the leverage that you have on that individual call option contract. So let's just say the $55 strike, right? So that is delta, that is gamma. The delta tells you how much you make. The gamma tells you what it takes to make this delta, right? And the theta is the last thing that's really important to understand. And that you can think of as time decay. It is how much, value, intrinsic value your contract loses with each passing day. And there's something that you're going to notice with all three of these different numbers, right? You'll notice that the delta will go up and the gamma will go down as this continues to run what we call in the money. And I'll explain that term to you here in a second, but that essentially just means that the strike price of your call option is trading underneath the current market value. So if we're trading at $55 right now, that would mean that $53 is currently in the money. So this delta and this gamma, you will see, reflect essentially the deeper they get in the money. You make more money the deeper it gets in the money, and it takes less of a swing in stock price or less gamma to make that cash. In the same way, you lose less theta, right? You have less theta on the table the deeper these run in the money, meaning that there's less time decay. You lose less intrinsic value on your strike, on your call option, as it continues to run in the money, right? So looking at the $55 strike, there's $1.58 theta right now for this Friday's $55 strike, meaning that with each passing day, you would lose about $158 of value if it were to stay exactly flat on the stock price, right? And how much would that actually be? Well, if the contract is trading right now on the ask side at $10.70 a share, which means $1,070 for a single contract, right? It would mean that you're losing somewhere between 10 and 15% of your overall value of that call option simply by the day passing if there's not any volatility to drive the price up on your call option, right? So that is what each of these three Greeks mean. As you get deeper in the money, the theta goes down, you lose less intrinsic value, there's less time decay on your call option, and the further out the money, the more risk you have with theta, gamma, and delta, right? You don't make as much on delta, you don't make as much on gamma, you lose more value on theta, and these are riskier riskier call options, right? So next I want to get into the following term, which is in the money and out the money. So in the money refers to, as I mentioned before, a call option that is less risky, right? You hold on to that intrinsic value much better because the theta is lower, right? The deeper in the money this is, the less time decay you have. And also the delta and the gamma is going to pay you more handsomely. It's just a more expensive call option contract, right? Now, a lot of where your money comes from is these out the money contracts, right? So out the money contracts are strike prices above the current market value. And while immediately you have a lot of time decay on the table, these are the riskier bets, essentially, that can really make you a crap ton of money, right? So, for example, looking at this right now, if you were to look at this, we'll just do $70 strike. The delta on this is 50.2 cents, meaning you make $50 for every 1 cent swing on the stock. But the deeper these start to run in the money, you make up a huge chunk of change for those to run in the money, right? You get a large chunk of what's already, included in the intrinsic value in these other strike prices. For example, look at this. The $54 strike as of yesterday was worth $11.05. Now, if you were to go 1, 2, 3, 4, 5, 6, 7, 8, 9, $10 up, you would gain $3 per share per contract, right? Which comes out to $300. It's a $300 difference for a single contract if this was to run in the money, just based on that simple arithmetic. Obviously, it's more complicated than that. You've got the delta, gamma, and theta, which all contribute, but you get my point, right? These out the money call options are riskier, but they usually pay more handsomely. And an easy way to think about this is with the risk and the premium, right? This is going to tell you the entire story. To make this super simple, think of premium as auto insurance, right? So you are going to pay more premium for a more secured, auto insurance, right? To secure your vehicle better. You're going to pay less premium, less insurance to not protect your vehicle as much. So for out the money call options, the premium on these is usually cheaper. You can think of it as I'm paying less premium for less security, right? I'm willing to take more risk to potentially make more money. The deeper in the money call options you can think of as higher premium because you're paying for more insurance, right? You want to hold on to that intrinsic value. You have less overall theta or the time decay, which gives your call options that intrinsic value, right? So this entirely comes down to your specific call option strategy, how much risk you like to take. Myself personally, I like to play just barely out the money, especially with some volatile call options, right? And this is a great example of volatility it is right now. So, the $58, the $60, that's more my cup of tea. But if you like to play less risky, you're looking for maybe a 20, 50, 60, 70% gain on a call option with some volatility, right? You can play in the money and you're still going to make some decent cash. You just have to have the liquidity to be able to purchase these call options that are in the money because they are more expensive if you're going to pay that extra premium for the extra insurance. In the money call options, less risky. Out the money call options, more risky. That's as simple as it gets. So now, to buy a call option, you buy it to open and you sell it to close. Now, what does that mean? It means that you want to hit the ask if you want to buy a call option. So, for example, if I wanted to buy the $60 strike, what I would do on Webull anyways is hit this $9.30, premium level, which is $9.30 per share, which comes out to $930 a contract. I would hit that, and then I would want to, enter how many I want. I would hit unlock trading. I would hit buy, and then I would have these, if I wanted to buy 10, I would have 10 call options. Now, to get rid of these, it's very simple. You sell it to close, meaning that just the same as a share, you would want to sell these if you don't plan on exercising, which we'll get into here in a second. You would want to sell these call options to lock in that premium and that liquidity that you've earned from the run-up, right? Now, there's a couple different strategies that you can use with call options if you'd like to, either average down on a stock or, create some gamma squeeze. Gamma squeeze meaning that you've got call options that were previously out the money. You bought call options, let's say it's $60, 65, 70. The stock price is trading at 50. It runs over $60 and it can cause a gamma squeeze. Market makers prepare for something called exercising contracts, right? Now, what this essentially means is that people who have call options that are in the money, they can choose to exercise these if they like, meaning that you have the right, not the obligation, to purchase 100 shares at your designated strike price per contract that you have. Since one contract is worth 100 shares, it means that that's what you can buy it for, right? So, for example, let's say that I was able to pick up these $40 strikes, for June 11th, and I got them 3 months ago. The premium on them at the time, let's say say it was $2 or $3 per share, which means it was $200 or $300. It would be worth it in that scenario to be able to give up that premium, because that's what you would do, right? You would pay that premium to be having the right to purchase 100 shares at $40, right? So what would the cost be if I wanted to exercise at that $40 strike? Let's just do the math here really quick. So if it's a $2 premium per share, that means that you are paying $200, right? So $200 for that premium, you give that up, right? You're paying that premium essentially to be able to lock in that $40 strike. So your total cost for this would be $40 times 100, right? Which would come out to, add these zeros, $4,000 plus that $200 premium that you gave up. You might think to yourself, is this really worth it? And in certain scenarios, it is. It depends entirely on, I think, one main factor, which is how much did you pay for that premium? If I paid a premium on these $40 strikes of $17.75 a share or $1,700, it's not worth it at that point to pick up these $40 strikes. But if you have, to exercise them, I should say. But if you have, a $40 strike, or you have a previously out the money call that is very deep in the money now, and you want to exercise it, and you want to give up that premium for the cheap strike price, that's an entirely different scenario that can actually create buying pressure. So those are the scenarios in which I think it's actually okay to exercise call options. So this is kind of a brief walkthrough, talk through. If you don't want to exercise a call option, you do not have to, right? Another strategy that you can actually employ is if you don't have the liquidity to exercise, meaning that you don't have the money available. Let's say that all you have in your brokerage, before these contracts is like, I don't know, $2,000, right? But it costs you $4,200 to exercise fully to get these $40 strikes on one contract. Well, what can you do is you can sell if you have other call options that are deep in the money and get those, the liquidity from those contracts in order to exercise if that's something that you'd like to do. That is a strategy, right? So those are just some different ways that you can take advantage of these call options, the liquidity that they can make you, the leverage that they offer you. Just know this, they are risky. Call options are risky. If you're wrong, you can lose that premium, right? That's where the risk factor comes into play. Do you like to play in the money? Do you like to play less risk? Do you like to play out the money? Well, more risk? It's entirely up to you, but this is a great way to leverage, and it's a great way to make money, especially in volatility, right? You don't want to play call options with stocks that are flat. That is the best case scenario for market makers, is stocks are flat. They don't like seeing that. No, they love seeing that, I should say, because that means that call options typically expire worthless, and they just collect all that premium. But in a situation like AMC, you can really leverage pretty heavy with some call options to make great money to either A, buy stock, B, exercise those calls, or C, do whatever you'd like to do, right? So this is kind of a brief walkthrough, talk through on call options. I know there's a lot of new people out there who are asking questions about them. Hopefully that helps you out. That's what I've got for you guys. So blah, blah, blah. I know the whole spiel. Drop a like and subscribe, whatever you want to do, my friends. Catch you on the next one. Much love and peace.